My name is Eric Bahn. I'm one of the co-founders at Hustle Fund, and welcome to today's AngelList Confidential session, which we're calling, So You Raised the Fund in 2021. Now what? In 2021, $57 billion was raised by venture capitalists alone in that single year. A gazillion new funds were raised, and new emerging managers, and even some of the established funds kind of lost their minds and raised way more capital than the previous vintages. So after getting a little bit high on our own supply, now is a come down period. We're facing a different kind of reality that feels a little bit more harsh, maybe a little bit more bitter. The valuations are lowering, markups are fewer and far between, and frankly, the data to convince LPs to keep supporting emerging managers is getting a little bit weaker. But maybe I'm just being a little bit negative. Joining me to help me dive into that question of what happens next after that bull run are two amazing emerging managers. We have Sarah Smith of Sarah Smith Fund and Rex Salisbury of Cambrian. Can we first start by having you each share a bit about who you are, when you raised your fund, and why did you start? So go ahead, Sarah, why don't you start with that?
Yeah. So I'm Sarah Smith. I have a rolling fund called the Sarah Smith Fund, and my fund is focused on tipping the odds in the favor of the CEO to go the distance. The thesis of my fund is based on some studies that Bain & Company did, where they show that if a founder stays involved in the company in the long term, they're 4 to 5 times more likely to be a top 25% performing company in the public markets. So my whole fund is based on the premise if I can help my founders get that far, then that will provide superior returns to my investors. So I invest at the pre-seed and seed stage, typically 100 to 500K checks, and in return, my founders get access to people ops office hours and a 360 review of the CEO, a lot informed on my time as an operator at Facebook and Quora for 10 years. Prior to this, I had been at Bain Capital for 4 years and had invested as an angel before that as well. I've seen firsthand being at Facebook and Quora early, how important the culture is and how much you define your values as a founder, which has to be authentic to you as a founder, because that's how you're going to retain and attract great talent, and it's also how you're going to sell and recruit and fundraise. And so I spend a lot of time with founders thinking through those early building blocks of how to build the foundation for them to stay and go the distance with the company.
I love that idea. We had something we used to say at Andreessen Horowitz, which was if you don't have like a head of people by the time you reach 30 folks, something will go terribly wrong.
Yes.
But with that, it doesn't really make sense to have a head of people before that. But until you get that, you should also be building the foundation. So you hire the right head of people, you already have the right proto processes and shapes. I think it makes a lot of sense. So I'm Rex. I am solo G. I run Cambrian Ventures. I am focused on pre-seed and seed investing in fintech. Prior to this, I helped start the investment team at Andreessen Horowitz when we were growing our fintech investment practice. And I spent a whole lot of time across the whole financial services ecosystem as a long time ago an investment banker, then later on as a software engineer, then investing at Andreessen Horowitz and now running my own fund. But how I accidentally ended up in venture is actually through community. So 2015, a few blocks away from here, I started bringing together founders and builders in downtown San Francisco to talk about interesting things we were building in fintech. That community grew. Now have a Slack community with 1,900 plus fintech founders, have a newsletter, a bunch of other stuff, and that pulled me to investing and advising. And so now I get to do, basically my whole job is investing and advising, but there's a strong kind of community element throughout it.
So I did stalk you on LinkedIn, both of you, very thoroughly. And Bain, A16Z, you clearly were rising leaders in those funds, but yet you still were inspired to strike off on your own. And I think we're all really curious about those kinds of inception stories, like why you wanted to, I think, leave some of those really great, amazing brand funds to go start your own. Sarah, you want to start with that?
Sure, I'm happy to start. Yeah, Bain is an incredible firm. I really enjoy my partners there. I was there for 4 years. I was also there during the years of very high valuations, and so I found myself at home mainly at the seed stage. It's also what I had been doing as an investor prior to joining was mostly seed investing. In the meantime, I also had taken over a program in 2019 running our fund of funds at Bain Capital, and fortunately had a lot of support from the partnership to back over 50 emerging managers. And in doing that, I partnered with a lot of them, and just hearing about their day-to-day and seeing how they were being able to really partner with founders and also be collaborative and frankly have a higher velocity of investments per year. For me, that was a lot more kind of where I feel at home and where I do my best work. So last year I decided to spin out and start my own fund. Fortunately, with a lot of support from the Bain Capital team, I still collaborate with them very closely, but I really like being able to invest. I roughly invest in 20 companies per year, which is obviously very different than being in a multi-stage fund.
How about yourself?
Yeah, I get asked this question a lot, and I think it's a little frustrating to hear it posed so often, because I think we have this understanding in the Bay Area that if you are at a very successful tech company and it grows big and everyone's super happy, you don't get asked like, why did you leave? At some point it's like, when are you leaving to do your own thing? And if you look at the venture ecosystem, 10 years ago was a fraction the size that it is today. But if you look at the big brand names in venture, they're huge. They have north of 500 employees in some cases, which is great. And they're great firms with great brands who provide great support to their founders. But people should go out and start their own things because that enriches the venture ecosystem. And then for you as a practitioner, like the work is just way more interesting. If you get inside of a large firm, you're going to end up with your Mondays and your Fridays totally blocked off. You're going to have a whole bunch of internal craft in between. You're probably also taking board seats, which is an important role and a great way to support founders, but it's also just going to create calendar hell. And then the amount of time you spend actually supporting founders is de minimis. And so if you like really like company building, if you think you have unique value in the ecosystem, and you just like want to have a better connectivity to like what's going on, you should start your own fund because it's way more interesting work. I'm a little biased. I decided to do that. So I think, maybe you can stick around, do some stuff. But I think, and then if you're a founder, like what kind of person do you want to partner with? Do you want to partner with someone who's like sitting there, who's been in the same place for 10 years? Or do you want to partner with someone who's like out there, they're hungry, they have very clear voice in the marketplace, very clear defined value in terms of what they will bring to you, and you know that like their success lives and dies by how much they support you? And I think founders also recognize that folks who are building their own things, much like they're building companies, make great partners for them. I would love it if the question became more of like an obvious answer, like, oh, like why are you like, or instead of why, it's more like, what are you going to do, or why are you doing this, as opposed to like, why would you ever do this?
I had a goal coming into the session that within 8 minutes I can somehow trigger Rex, and nailed it. So love it.
I'm easy. They're like, oh,
I know.
I didn't take the bait.
I think we're all a little bit salty because we all have like a little bit of young kids right now, so the lack of sleep is getting to us a bit.
That is true.
Let's see if I can trigger you both some more though. So, but this next one I think is a less triggering question. And Sarah, you've made the decision when you left Bain to start Sarah Smith Fund to opt for a rolling fund structure with AngelList. Why rolling? It's a relatively new concept still.
Yeah. So fortunately, running the fund of funds at Bain, I had a really unique perspective into hundreds of micromanagers and solo GPs, and I was actually the LP on the other side. And for me, it was really important to have a superior LP experience. And I felt that the back office and the backside of what AngelList was doing was like far superior to the other platforms. For the rolling fund specifically, I also wanted to be able to be in business from day one. And the nice thing is you can always be accepting new LPs with a rolling fund. And so literally the day I wanted to start, I was able to start investing in companies and not turn off my deal flow. I also really like the idea of building kind of it's almost like the similar analogy of an ARR business versus like a 2 to 3 year multi-service agreement. We pushed all of our companies to have more predictable revenue. I think a rolling fund does a similar type of thing. I require my LPs to commit to 8 quarters. So as a GP, you can set those parameters. So in that way, mine feels a little bit more like a traditional fund, even though it's on the rolling fund structure. I also really want to be able to bring in exceptional individuals as LPs at any time versus waiting 2 or 3 years. So half of my LPs are women. I'm really proud of that fact. And I think a lot of it is because of the flexibility of the rolling fund structure. But I also have this early market bet that I do think AngelList is going to have like dominant market share as back office provider, source of truth of all data. And I just feel like the product engineering and data teams are far superior at AngelList. And so I wanted to be on the platform that I thought was going to ultimately like win the whole market.
That's awesome.
And as an LP in 50 funds, in terms of working with platforms, I'm curious to hear your perspective.
And I've also been a personal LP in funds too for even longer prior. And I mean, to me, it's like night and day. It's not even a comparison in terms of like the technical capabilities of what the AngelList like back office provides compared to some of the other platforms. Now, I think there is a question like institutional LPs, I think are beginning to embrace AngelList more, but they are used to other tools, and so there's like some education that needs to happen. But I believe that for sure in the next few years, AngelList will be the dominant platform.
Yeah, totally.
Rex, you're in the AngelList family too, but you opted for a more traditional fund structure. Can you tell us a little bit more about why not rolling, and why did you pick something a little more traditional? Yeah,
so traditional fund is in part one of the big reasons is what the product that LPs are most used to. It also gives you durability, kind of a defined period for investing, a defined period in which to work out returns. But I think it's great that there are all these different kinds of products in the ecosystem, because again, if you go back 10 years or about 10 years, there's really only one way to go and start a venture fund, and that's already be very wealthy, spend like 6
Yeah.
months, spend a few $100,000 on lawyers, on entity formation, hop on a plane, fly to some like very specific places, and then like a year or two later, you're up and running with a 10-year, traditional venture fund. Today, you can get started as an angel doing personal checks and then SPVs on the AngelList platform. You can then step in and you can do a rolling fund. You can take a rolling fund and make it behave very much like a traditional fund if you want to, and it actually has a lower cost structure associated with it and some other things. So that's great. It's a product that people aren't as used to, but if you start to come up with these default parameters around new products, and I'm someone who invests in financial services technology, and part of financial services is innovating on the product side of things, not just the technology side of things. And so AngelList has done a little bit of both. So I think it's great that you have this much more seamless on-ramp into the types of people who can do venture, because venture is now 10 times bigger as an asset class than it was 10 years ago. Well, not 10 times, it's 3, 4, 5 times bigger. And we should have a lot of specialization. We should have funds that specialize in certain areas, whether that's fintech, healthcare, that provide very specific value, whether it's helping like people ops or mine is providing network connectivity into fintech. And we should have very different ways in which you can actually structure that fund in that vehicle. And over time, some of those new ways of doing things, they're not going to like take over the entire ecosystem, but they can be meaningful subcomponents of what is now a much larger asset class.